All right, thanks for joining me today on Discovering My Dividends. And well, today I'm going to be talking about how I quit the big banks and mutual funds and started trading stocks. So I'm going to get into a little bit of how I started into building my strategy. So last year, 2025, I made 30% gains on trading stocks, and I only traded Canadian stocks. Now, the after 10 years of kind of trading back and forth, I did 3 years developing my strategy. Before that, I did options trading, and I say that loosely because I was still kind of learning a lot of things about what my trading style needed to be. So then I kind of decided here, now I'm ready to do my challenge. So I got kind of this 3 years of building up a strategy, and I'm now putting it into place. So 2025 was my first chance to kind of do that as an overall experiment. So just a little disclaimer, I'm not an advisor, so anything on here is not advice. I'm just sharing my experience, and if that helps you to kind of find your own path, great. But definitely I wouldn't consider this to be kind of a rock solid plan for everybody. It kind of depends on your own trading style. So I realized mutual funds combined with my contributions were not going to really reach that kind of objective I wanted to, which I didn't really 100% know at the time what it was. It's kind of something I needed to kind of explore, and I wanted to make $1 million. I wanted to have $1 million in an account and go from there. And so I started looking for a solution to reach that goal, and I kind of figured out the answer was compounding. So I had to figure out a way to take the small amount I was putting in and compound it quickly, I guess is probably the best way to put it. So how did I compound my investment? Well, I was doing $50 a month, which isn't obviously that much. I had, at the time when I started trading, I had a pension and other stuff. So, I mean, it wasn't my only form of retirement money. So essentially, this was kind of an extra, and I guess that's what took me so long to kind of decide how important it was. And so I decided I was going to trade daily, though. So that's how I was going to compound it, or as many times as possible. So sometimes I trade, once I traded up to like almost 20 times in a day, like turning that over. I had a day off, and the trades were just like going up and down, and I kept buying and selling, and it was just kind of one of those days. And so that worked out really well that day. And other days you can do a trade and completely miss it. So but it kind of solidified me that compounding would be the best choice. So every trade I create, I want to get a 1% gain of the price I paid for the stock. So whatever I buy for a dollar value, I want to have a 1% gain when I sell it. And that's really how my compounding is structured, is through a 1% gain. So how it works is I'm going to take, let me see here. See if I can illustrate this a little better. So I'm going to take a $5 stock and do an example here. And not that every stock's going to be $5 or that it's going to be $5 right on the nose. Obviously, with fluctuation, it's going to change. But just to keep things simple for the math that I have, that's what I'm going to do. So let's get rid of this, get rid of that. Oh yeah, whoops. Of course, I was not overly ready for this, apparently. Okay, I was, but I wasn't. Okay. All right, so let's start recording this. All right, so if I have a $5 stock, $5, and I buy, or sorry, let's scratch that. I have a $10 stock, let's do $10, and I buy 5 stocks. I'm putting in $50 a month into my account, so say right at the beginning, that's going to cost me $50. So a $50 stock, I'm going to earn 1% each trade. Then let's see, each trade will give me 50 cents. So I'm going to earn 50 cents. All Okay, so essentially what I'm going to do is I'm going to have 1% each at 50 cents, so 20 trades should give me $10. $10 earned. There we go. All right. So now I can buy 6 stocks. So $10 stock times by 6. I've now got $60. And that's how it works. So every time I can do 20 trades, I can do that. Now, if I do 20 trades in a month, that's 5 trades a week, which is kind of roughly what I want to do. So 5 trades a week per week, or 20 trades per month. All right, so let's stop that. And that's kind of how it kind of looks, the compounding. So you can see just by trading those, I went up $10, and it takes 20 trades to do that at 1%, but it was okay. I've now got a whole extra share I can buy and sell. So the extra share is now making me 10 cents. Okay. Now that doesn't really sound like a really exciting prospect, but when you start going, okay, well, if I do that every month and I have an extra share I can trade every month, it starts compounding, and extra. Now those extras start making me extra. It snowballs, right? So then I can, by the end of the year, get to a lot higher. And of course, at the end of the month, I'm going to add another $50. So not only do I get the $10 that I gained trading during the month, I get another 50. So I'm now up, instead of 50 that I started at the first month, I've now added $10 through trading and $50 just my regular addition. Now I've got $60 plus $50, $110, and the show goes on. So that's really the whole aspect of really kind of what I got going on in my mind. And I set up a whole spreadsheet, and I saw how that compounding would work. And I figured out I could make $1 million, which of course, if I was just putting $50 a month away and just putting in a savings account, it's going to be way less. Or if I put it into mutual funds, the return's going to be a lot less. Now there is room for risk in here. So something could happen that I might not make that much, which could have slowed it down. But I look at the end of the day, and I figure if I invest in the stocks that the mutual fund companies are investing in, or that I'd like to invest in, that are going to give me dividend returns, then the worst case scenario is I'm going to make 4 to 5% a year. And 20 years from now, I'm still going to have some money. I'm going to have dividend returns building it up. So it is going to compound on its own. If I keep doing the trading, of course, it goes faster. So the better I do the trading, the faster it goes. The worse I do the trading, the more I look like a mutual fund, or maybe slightly less than a mutual fund, but I have much more potential for the risk that I'm taking on. All right, so I do use WealthSimple. They don't sponsor me. I'm not promoting them. I'm not going to say they're the best for you, but I like them. So if you are looking for a broker that's easy to use and you don't pay fees on Canadian stocks and ETFs, check out their fee structure for you, see if it works. But I do have a link below. If you do that, we both get a reward for you signing up and using WealthSimple. Go ahead and do that. Now, my next video, I'm going to explore how to make 250 trades and without a single loss. That's what I did last year, and I'm going to kind of go through that and let you know how I made that work. So we see you for the next video.